CVP analysis, cost value and profit. Cost value and profit CVP analysis is a financial tool used by businesses to understand how changes in cost, sale volume, and price affect profit. It helps in making important decisions such as setting price, choosing product lines, or planning sales target. What CVP analysis show? First thing, CVP analysis show the relationship between selling price per unit, cost per unit, either fixed or variable, sale volume, unit sold, and the last one is profit or loss. By analyzing this relationship, businesses can estimate how many units they need to sell to. First, break even, no profit, no loss. Second one is achieve a target profit, and the last one is understand the impact of cost or price changes.
Hi everyone, my name is Ahmad Luqman Haris bin Zafrizan and my matrix number is 306691. I would like to talk about the part A, question 1. So let's begin with the CVP style income statement for EcoGlow Lighting Sdn Bhd for the year ended 31st December 2024. In 2024, EcoGlow sold 50,000 EcoBright small LED bulbs for 25 ringgit each, generating a total sales revenue of 1,250,000 ringgit. The company incurred the following variable costs: 625,000 ringgit in variable production costs, 150,000 ringgit in sales commission calculated at 12% of total sales. This brings the total variable cost to 775,000 ringgit. From this, the contribution margin is 475,000 ringgit after deducting variable costs from sales. Next, EcoGlow fixed cost amounted of 270,000 ringgit, including manufacturing overhead, digital marketing, website maintenance, factory rental, administrative salaries, and utilities. Finally, the company reported a net operating income of 205,000 ringgit. Now, let's look at the key CVP formula and calculation for EcoGlow Lighting Sdn Bhd in 2024. To get the selling price, we calculated total sales 1,250,000 ringgit divided by the unit sold, 50,000 units. From that, we can get the selling price per unit for EcoBright. It is 25 ringgit per unit. And now, to get the total variable cost, we need to calculate the sales commission first, where the total sales 1,250,000 ringgit multiply with the commission rate 12% and get the total of 150,000 ringgit for the sales commission. And then we need to find the total variable cost. We calculate cost of goods sold variable 625,000 ringgit plus with the sales commission that we get earlier 150,000 ringgit, and we will got the total 775,000 ringgit for the total of the variable cost for EcoBright.
So question C, variable cost per unit in RM for EcoBright. To get variable cost per unit in RM, we need to total variable cost divide by unit sold. So our total variable cost is RM 775,000 divided by 50,000 unit So our variable cost per unit is RM50.50. So question D, variable cost of goods sold to sell price ratio for EcoBright. Variable cost of goods sold to sell ratio is variable production cost divided by total sales. So RM 625,000 divided by RM 1,250,000. So our variable cost to sale ratio is 50,000.
I will present our total fixed cost, which amount 217,000 ringgit. So the detail is fixed manufacturing overhead is 120,000 ringgit, digital marketing 35,000 ringgit, website maintenance 10,000 ringgit, factory rental 13,000 ringgit, administrative salaries to 16,000 ringgit, and utilities and insurance is 1,500 ringgit. So altogether bring the total fixed cost to 217,000 ringgit. Now let's move on the contribution margin per unit. The contribution margin tell us how much we earn from each unit sold. After covering the variable cost, this amount contributes to covering our fixed costs and generating profits. The formula is contribution margin per unit equal selling price per unit minus variable cost per unit. In our case, 25 ringgit minus 15.50 ringgit equal to 9.50 ringgit per unit. So for every unit we sell, we earn RM 9.50 to cover our fixed cost and profit.
Question G. The contribution margin ratio. First, we calculate the selling price per unit. Total sale is 1,250,000 ringgit. Units sold are 50,000. So selling price is 25 ringgit per unit. Next, we calculate the variable cost per unit. Total variable cost include production is 625,000 ringgit and commission 150,000 ringgit, which equals 775,000 ringgit. Divide that by 50,000 units. We get 15 ringgit and 50 cent per unit. Now we find the contribution margin per unit. Selling price 25 ringgit minus variable cost 15 ringgit and 50 cent equals 9 ringgit and 50 cent. Finally, we use the formula contribution margin ratio equals 9 ringgit and 50 cent divide by 25 ringgit, then multiply by 100%, which gives us 38%. This means 38% of each ringgit earned goes to cover fixed cost and profit. It's a useful tool for making business decisions. Part H. We are required to calculate the break-even point in units. To calculate this, we use the formula break-even point equal total fixed cost divided by contribution margin per unit. From our previous answer in part G, we already know that the contribution margin per unit is 9 ringgit and 50 cent. This is the amount of profit the company earns from each unit after separating all variable costs. Now, we identify the total fixed cost. This includes fixed manufacturing overhead, 120,000 ringgit. And then digital marketing cost, 35,000 ringgit. Website maintenance, 10,000 ringgit. Factory rental, ringgit, administrative salaries 60,000 ringgit, and utilities and insurance 15,000 ringgit. When we add all of these fixed costs together, the total is 270,000 ringgit. Now we divide 270,000 ringgit by 9 ringgit and 50 cent. The result is 28,421.05 units. Since we cannot sell a part of unit, we round it up to a nearest whole number. So the break-even point is 28,422 units.
Okay. Today I will be presenting about the break-even point, or BEP for short. This is the point where a business make no profit and no loss. In other words, when total revenue equal total cost. First, let's look at the selling price per unit. The total sale are 1,250,000 ringgit, and the number of units sold is 50,000. So selling price per unit is 1,250,000 divided by 50,000 equal 25 ringgit per unit. Second, we calculate the total variable cost. There are two components. First, production cost 625,000 ringgit. Second, sales commission 150,000 ringgit. So total variable cost is 625,000 plus 150,000 equal 775,000 ringgit. Third, we find the variable cost per unit, that is 775,000 divided by 50,000 equal 50 ringgit and 50 cent per unit. Fourth, we calculate the contribution margin per unit, which is selling price per unit minus variable cost per unit, 25 ringgit minus 15 ringgit and 50 cent equal 9 ringgit and 50 cent. This is the amount that goes to work covering fixed costs and generating profit. Fifth, we feed the cost for the business are 207,000 ringgit. Six, we calculate the break even unit. That means how many unit we need to sell to cover all the costs. We divide fixed cost by contribution margin per unit. 270,000 divided by 9 ringgit and 50 cent equal 28,421 per unit. 7. We find the break-even sale amount in ringgit. We multiply the break-even unit by the selling price per unit. Okay. Net income to sales ratio for EcoGlow. In this presentation, I will explain the net income to sales ratio for a product called EcoGlow. This ratio shows how much of the total sale is actually converted into profit. In simple words, it tells us how efficient the company is in generating income from its sale. Firstly, let us look at the given figura. The net income is 205,000 ringgit. The sale revenue is 1,250,000 ringgit. To calculate the net income sale ratio, we need use the formula net income divided by sale revenue, then multiply by 100%. So the calculation would be 205,000 divided by 1,250,000, then multiply by 1,000. The result is 16.4%. EcoGlow Lighting target 28% net unit. 1. Cost breakdown per unit. Material cost up 4%, 13 ringgit. Sales commission 3 ringgit. Total variable cost 16 ringgit. 2. Profit per unit. Selling price 25 ringgit minus cost 16 ringgit. Profit 9 ringgit per unit. 3. Sales target. Unit to sale 135,000. Total sale 3,375,000 ringgit. Net profit 270,000 ringgit.
So part B, scenario number 2, price adjustment strategy. The question is the company cannot increase unit sales beyond 50,000, determine the new selling price per unit required to meet the 28% net income target, and discuss the risk and feasibility of this pricing strategy in competitive market. So what we already know, the sale is 50,000 unit, production cost went up, now it's RM30 per unit. Sales agent get 20% commission on selling price. Fixed cost stay at RM270,000. So the last one, they want a 28% profit margin on total sales. So what do we need to find is the new selling price per unit that helps the company achieve a 28% of profit margin, even if they still only sell 50,000 units. So let's call the selling price is X. Commission per unit 12% of X equals to 0.12X. Total variable cost per unit RM30 our production plus 0.12X commission. So our new equation is 30 plus 0.12X. Profit per unit contribution equals to selling price minus variable cost. So we get X minus 30 plus 0.12X, so equals to 0.88X minus 30. Total profit before fixed cost equals 0.88X minus 30 multiplied by 50,000. Profit after fixed cost equals to total profit minus fixed cost. So our target net profit equals to 28% of total sales. 28% multiplied by 50,000 multiplied X equals to 40,000X. So we get our new equation is 0.88X minus 30 multiplied 50,000 minus 270,000 equals to 40,000X. So we just solve it and we get X equals to RM30 ringgit and 67 cent. So the notes at the right of the slide, we let the new price DX from each sales that company only keep 88% because of 12% commission. Then we minus RM30 cost to find how much is left to cover fixed cost and profit. We solved the equation and found that the price must be RM30 ringgit and 67 cent to reach the 28% target. So the risk is too expensive compared to competitor. customer might be choose a cheaper brand. So second one is lower sales. A high price can make people buy less, especially if they think the product is not worth it. The last one is bad customer reaction. Without new feature, customer may feel the company is overchanging. So for feasibility consideration, first one is cost-based justification. The increase to RM 30 ringgit 67% is based on real cost change, raw material price increase, and maintaining profitability. From a financial view, is feasible and logical. The last one is achieve profit goals. This strategy allows the company to reach the target 28% net income to sales ratio without needing to increase the number of units sold.
In Scenario 3, EcoGlow plans to respond to rising raw material costs by investing aggressively in marketing and improving cost efficiency. Under this plan, the selling price increased to 28 ringgit per unit, the sales commission rise to 16%, fixed costs are reduced by 30%, the sales volume doubles from 50,000 to 100,000 units, raw material cost is increased 4%. From our calculation, it shows that the variable cost per unit is 17 ringgit and 48 cents. How did we find this? First, we need to find the 2024 variable production cost per unit. We need to divide variable production cost divide by the sales unit in 2024, which is 50,000. And then we will get 12 ringgit and 50 cent. After that, we multiply it with 4% increase with RM string 1 ringgit and 4 cent, and we will get 13 ringgit. We need also to find the new sales commission, where we take the 16% and double it and multiply it with 28 ringgit, and we will get 4 ringgit and 48 cent. And then we plus the both of it, and we will get the variable cost per unit. And then we need to find the contribution margin per unit. We take selling price per unit 28 ringgit minus variable cost per unit 17 ringgit and 48 cent, and we will get the total of 10 ringgit and 52 cent. For the contribution margin ratio, we take the contribution margin per unit 10 ringgit and 52 cent divided by the selling price per unit 28 ringgit and get 37.6%. The new fixed cost is reduced by 30%. So we take the original fixed cost, multiply with the balance of 70% and get the total of 189,000 ringgit. The new sales is 100,000 units multiplied with 28 ringgit, and we will get the total of 2,800,000 ringgit. The total contribution margin is we take the new sales 2,800,000 ringgit multiply contribution margin ratio 37.6%, and we will get the total of 1,052,800 ringgit. The net income is the contribution margin 1,052,800 ringgit minus fixed cost 189,000 ringgit and get the total of 863,800 ringgit. The net income to sales ratio is net income 63,800 ringgit divided by sales 2,800,000 ringgit and get 30.85%, exceeding the 28% target. This strategy appears viable as it meets the target while enhancing brand presence and operational efficiency. However, it depends on whether the company can actually achieve the double sales volume through its marketing efforts.
In future expectation after grow, what happened when our business grow is we expect our sale volume to increase by 150%, so we will sell 125,000 units. That give a new sale revenue of 3,125,000. Our cost of goods sold increased to 15,000%, which is RM 1,781,250,000. Digital marketing cost goes up by 30%, so now it is 113,000. Fixed cost stay the same at 300,000. New net income is RM 3,125,000 minus RM 1,781,250,000 minus RM 300,000 minus 130,000 equal to RM 913,750,000. So new net income to sale ratio is RM 913,750,000 division to RM 3,125,000 equal to 0.2924, or we get 29.24%. The summary, so with high sale and some cost change, our net income increased a lot from 15% to 29.24%. This show that growing the business can bring much better profit. Now I will explain the comparison between our current situation and what we expect to happen after growth. Current situation is our selling price is RM 25 per unit. We are selling 15,000 units, so our sale revenue is 1,250,000. The cost to produce the cost of goods sold is 53%, which equal RM 662,500. Fixed costs are 300,000. Digital marketing costs 100,000. After we minus all the costs, the net income we get is RM 187,500,000. So the net income to sale ratio is 187,500,000 division RM 1,250,000 is 15%.
So 5. Explain about the two options we are considering for restructuring our sales team in 2025. For the first option, we are looking at keeping our current external sales agent but increasing their commission rate to 18%. With this increase, is expected that our total sales will go up by 50% compared to the current figure. If we assume our current sales are 1 million ringgit per year, this means sales could grow to 1.5 million ringgit. However, with the higher commission rate, our total commission expense would reach 270,000 ringgit Malaysia per year, which is quite a significant cost to bear. Now, moving on the second option, management is considering hiring 8 full-time in-house sales representatives. Each of them will be paid a fixed monthly salary of 1,700, which adds up to 163,200 a year for the team. On top of that, they also receive a 4% commission based on total sales. With this setup, we are projecting an ever better sales increase of 70%, which would push our total sales to 1.7 million ringgit annually. The total commission payout in this case would be 68,000 ringgit Malaysia, and when we add the annual salary cost, the total expenditure for this option would be around 231,200 ringgit per year. When we compare both options, it's clear that option 2 offer better value, not only because it delivers a higher increase in sales, but also because the total cost is lower than what we pay if we stick with external agent at the higher commission rate. Plus, with in-house team, the company would have more control over daily sales activities, staff performance, and customer service quality. So overall, my recommendation would be to process with hiring the in-house sales team, as it's a more cost-effective and scalable option for our business moving forward. I'll be explaining the calculation for the break-even point and the net income to sales ratio for our business. Let's start with the break-even point. First, we need to find out the selling price per unit, which is calculated by dividing the total sales revenue by the number of units sold. So we take 1,250,000 ringgit Malaysia divided by 50,000 units, and this gives us 25 ringgit per unit. Next, we calculate the variable cost per unit. We add up the total variable cost, which are 625,000 ringgit Malaysia and 150,000 ringgit Malaysia, giving us 775,000 ringgit Malaysia. Then we divide this by 50,000 unit and we get 50 ringgit 50 cent ringgit Malaysia per unit. After that, we find the contribution margin per unit, which is the selling price per unit minus the variable cost per unit. So 25 ringgit minus 15 ringgit 50 cent, and the contribution margin is 9 ringgit 50 cent. Now we move on to calculate the total feed cost. We add up all the feed expense, which are 120,000 ringgit, 35,000 ringgit, 10,000 ringgit, 30,000 ringgit, 60,000 ringgit, and 15,000 ringgit. When we total them up, it comes to 270,000 ringgit, which that we can now find the break-even unit. We take the total fixed cost, 270,000 ringgit, and divide it by the contribution margin per unit, which is 9 ringgit 50 cent. This gives us 28,421 units as our break-even point. Lastly, to find the break-even sales value, we multiply the break-even units by the selling price per unit. So 28,421 unit times 25 ringgit, and we get 710,525 ringgit. That's the same amount we need to achieve to cover all our costs. Now the final part, the net income to sales ratio. We simply take our net income of 205,000 ringgit, divide it by the total sales revenue of 1,250,000 ringgit, and multiply by 100 to get the percentage. And then uh, and then 205,000 divided by 1,250,000 times 100 equal 16.4%. This means for every ringgit of sale, 16 ringgit 4 cent is our profit.
In conclusion, we recommend that EcoGlow Lighting implement a moderate price adjustment to 28 ringgit per unit. Strategically invest in digital marketing initiatives to drive customer engagement. Reduce fixed operational costs by 30% through efficiency improvement and enhance production and logistic capabilities to support increased demand. Collectively, this action will enable the company to surpass its 2025 profitability target while significantly strengthening its competitive position in the smart lighting industry.